Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. I don't know about you guys, but for me, Warren Buffett is one of the best investors out there. After reading The Intelligent Investor and knowing that Benjamin Graham, who wrote that book, was Warren Buffett's professor, and Warren Buffett really liked him and used basically his knowledge to beat the market year after year. For me, he is honestly by far one of the best. And you just have to look at the returns in his own investment, beating the S&P 500 10 plus years for a very, very long time. It is quite impressive. And what I like about him is he makes everything sound, especially investing, very simple. Like, for example, he will say things like, rule number 1 is don't lose any money. Rule number 2, don't forget rule number 1. That kind of thing sticks out for me. Like, I genuinely admire the guy for what he's done for investors, especially retail investors. And if you read that book, I know he's not basically the author of that book, right? But if you read that book, you'll understand where he's coming from. He talks about marginal safety, owning a business that you understand, and that kind of thing, right? I'm putting together a video now, so I will talk about more about his investment philosophy side of things. But what I want to do today and what I want to share with you is I looked at his portfolio recently and I thought, you know what? Quite a lot of the companies in there are Sharia compliant. Some which I own, some which I don't. So what I want to do today is I want to share with you 10 companies that are in his portfolio that are Sharia compliant. So I'll show you first the details of these companies. Then I will share with you the Sharia compliance side of things so you can make your own decisions about that. And inshallah, the most important thing for me is that you don't gain something from it. And obviously for a bit of entertainment, a bit of try to understand, you know, what this guy's investment philosophy is and so on, that will come later. But for now, at least, let's see just his portfolio and what actually tells us, okay? And one of the things I like is when it comes to performance, so his total return in the last 10 years is 340%. And in comparison to S&P 500, 165. Total returns is quite similar. The total return for his own investment, okay, we're talking about, by the way, Berkshire Hathaway, which is basically his company that he owns. And that company, he owns million different companies, not million, but obviously quite a lot of companies. 240% to the S&P 500, 222%. So he has beaten the S&P 500 when you look at the year after year. So what I want to share with you now is 10 different companies that are in his portfolio that are Sharia compliant. But before we do that, do me a huge favor. Just press that like button because it genuinely helps the channel and definitely appreciate. Thank you. So we're just going to look at the usual things, okay? Nothing too fancy. The most important thing for me is that kind of give you an overview and then you're going to go away and make your own decisions and obviously do your own research, inshallah, okay? So the first company we look at is Apple. He owns, I think, over $100 billion of this company. I think almost 900. And I will show you the breakdown of his portfolio in a second. But as you can see, Apple has... it doesn't have a wide economic mode. Actually, it has a narrow, so that's a mistake. Okay, so that should be a narrow economic mode. So I'll change that now. And it almost has a $2 trillion of market cap. Price is $133 per share. Dividend yield is just below 1%, 8 basically percent of 5-year growth rate. Payout ratio 15%. Dividend streak of 10 years. They will give you about $1 for every share that you own. 99%, which is the highest that you can get. In terms of safety, profit margin is good, return on equity is excellent, free cash flow of $111 billion, okay, total return of almost 22% in the last 10 years. Next year, they're expecting the earnings to grow about 9%, and then after that, basically 9% every year after that. So it's about 4% discounted right now, $130 per share is where it should be. Next one is CVX or Chevron. This is an oil company that we've spoken about recently. If you're interested, find out a bit more information about the company. Go and watch that video that I did last week. It has a narrow economic mode, $339 billion market cap, price is 177. Dividend yield 3.22, which is quite high. 5-year growth rate 4%, payout ratio only 32%, and dividend streak of 34 years of increasing that dividend. Payout $5.68. Safety 90%, which is quite good. Profit margin, return on equity is decent. Free cash flow $38 billion. Total return of 7%. Next year, they're expecting the earnings to decline a little bit because of oil prices going down on hope. And hopefully the price of this stock will come down a bit. Okay. And because this is one of the companies I'm looking at currently, possibly adding to my portfolio. Growth estimate next 5 years, we're expecting about 15% and then 17% premium right now. $149 per share is where the price should be. Next one is a company he owned in his portfolio. I don't think this is a long-term investment because he did say, obviously, he's investing in this company based on what's happening to the company. The company will be acquired sooner or later by Microsoft. I don't think the SEC or anyone else will fight with Microsoft. I'll be honest with you. There's a basically court situation going on right now. But I think in the end, Microsoft will own this company. Currently, trading $78 per share. Dividends quite low. 5-year growth rate of dividend growth rate of 9%. Payout ratio 17%. Dividend streak of 0 years. So they haven't increased that dividend consistently. Annual payout just a $0.50 basically, less than that. Safety 99%, profit margin of 22%, return on equity of 9%, free cash flow $1.67 billion. Total return in the last 10 years, you would have made about 22%, 28% next year expected in terms of earnings growth, and then growth estimated for the next 5 years is 8%. 16% discounted right now, $92 per share is where it should be. According to Microsoft, I think they're buying it for $95 per share. So it'll be interesting to see if that deal goes through. I think some people that own it, put the stock right now, might be making a good money if it goes up to that price. If you bought it at least in the 60s. I used to have that this company in my portfolio, but sold it just after the announcement. Because if this deal doesn't go through, I think the stock is going to tank. But if it goes through, then you can make about $95 per share, which is quite nice, right? Moody's is another company. It has a wide economic mode. Moody's is very similar to S&P Global. It's a financial services company. A market cap of $50 billion, $297 per share right now. Dividend is just below 1%. 5-year growth rate of 11%. Payout ratio only 29%. 12 years of increase in that dividend. $2.80 is what you will get. Safety wise, we're looking at 83%, which is quite nice. Profit margin 27%. Return on equity 64%. $1.1 billion of free cash flow right now. Total return in the last 10 years about 19%. 11% growth next year and then decline out of following years. 5% discounted right now. $290 per share is where it should be. Next one is TSM, and this company is actually one of the recent purchases that he added to his portfolio. Okay, it has normally he doesn't add a lot of technology companies, but I was quite surprised because he had a huge Apple, obviously Apple in TSM, right? Every basically chip that this company uses actually is right now made by TSM, so it kind of makes sense if you like. Okay, $387 per share, market cap, and $81 per share. Dividend yield 2.28%, 5-year growth rate of 9%, payout ratio is 30%, 3 years of increase in that dividend, 1.4 or $1.40 in terms of annual payout. Safety 62%, anything above 61, we accept that. Profit margin and return on equity is absolutely amazing. $16.7 billion US dollars and your free cash flow right now, 17% total return in the last 10 years. Just like everything else in the semiconductor companies, is a decline next year, and after that should be okay. About 22% after that, 43% discounted right now. This is probably one of the quality companies out there that's very much required in every single sector, if you think about it, whether it's EVs, whether it's anything mobile gaming, everything, right? So the just chips that are made by this company, it goes into all of these things, right? And $133 per share is where it should be. So that's probably one of the future companies if you think about it. ASML and this company are really in a good place. MasterCard, in fact, I'm going to do the next two together because MasterCard and Visa are almost identical. They both have wide economic mode. They both currently trading. Well, one is trading $374 per share. The one is trading $221 per share. Dividend-wise, it is below 1%. 5-year growth rate, 18%. Both of them. In terms of payout, is not much of a difference. But in terms of dividend streaks, basically looking at about 10 years for MasterCard, and Visa 14 years. Annual payout just $2.28 for MasterCard and $1.80 for Visa. And then the safety wise, the 99%, which is the highest you can get. Profit margin, return equity, very similar. In terms of free cash flow, Visa has more free cash flow of $17.8 billion, whereas MasterCard is only 10 billions. And then total return in the last 10 years almost identical, 21 about an 18, right? And the next couple of years, basically, they're expecting growth-wise, okay, 15%, 16%, and 21% and 15% respectively. So in terms of discount right now, one is 5% discounted, one is 8%. So if you were to buy right now, basically you're buying at these companies at discount. That's what it means, okay? Next company we're looking at, again, those companies are very quality businesses, okay? Those two are really genuinely one of the best companies out there. If you look at your pocket right now, you'll find either Visa or MasterCard. Their business is not going anywhere despite what cryptocurrencies and all of these things to have to offer. I don't think their business model is going to go away anytime soon. In fact, it's going to get better and better. McKinsey is another company he owns. It has a narrow economic $53 billion market cap, $387 per share, less than 1% dividend yield, 5% 5-year growth rate of 10%, payout ratio looking about 8%, dividend streak of 9 years. Annual payout $2.16, safety 88%, profit margin and return on equity is not great. That's the only negative I can say about this company. Free cash flow of almost $4 billion. Total return in the last 10 years about 15%. Okay, and then when you look at this 7% next year, it's about growth expected 7%, 11% following year, 7% premium right now, $348 per share is where it should be. The next one is UPS. That's the company that I own in my portfolio. $150 billion market cap, $183 per share, 3.4 billion and 3.4 dividend yield, which is actually quite nice if you think about. In terms of growth, 6% in the last 5 years. That dividend grew. Okay, payout ratio looking about 43%, which is quite nice and low. They have room to improve that. In fact, last year I think they improved. Basically, they increased that dividend about 43%. I think it was. Dividend growth rate will like 12 years. Payout ratio $6.08, and safety we're looking at 69%, which is quite nice. Profit margin and return on equity is actually good. Free cash flow $10 billion, total return 10% last 10 years, and then expected next year to grow minus 5%, but the following year about 5%. This is the type of company that will grow about 5 or more percent. In the last few years was a lot more, but then obviously there will be situations because of COVID, everyone was getting delivery, so they did really well. So there's a little bit of decline right now. Fairly value right now, $179 per share. That's another company, by the way, I own in my portfolio. And finally, another company that I own in my portfolio, which is Procter & Gamble, has wide economic mode, $356 per share, per billion dollars, sorry, market cap, and $154 per share right now. Dividends is actually nice, 2.37, 5-year growth rate of 5%, 62% payout ratio. So for me, this is I think this is the highest in this list as well. Okay, so it's slightly on the higher end. Hopefully they can reduce that. Dividend streak of 66 years. That's why I'm not worried about this company, because they are dividend king. Annual payout, we're looking at about $3.65 and 99% in dividend safety. So that means they're not going to cut this dividend despite having a payout ratio that's quite high. Profit margin, return on equity is actually very good. 13%, $13 billion of of free cash flow. Sorry, return on equity 10%. Next year expecting 7% growth. After that 5%. This is the kind of company again that grows from 3% to about 10% every single year. Decent consumer staples, predictable business if you like. 20% return on premium right now, $125 per share, where it should be right now is trading $154. There you have it, 10 different companies. I'm going to show you from Sharia's compliance side of things, okay, because one of the things that I like to do is make sure that you know exactly, okay, if this company is Sharia compliant or not. This information, by the way, is not something I made up. It comes from Zoya. Okay, they don't sponsor this channel or anything like that, but I just want to let you know that is where I get the information from. So look at that. You can actually pause the video and have a look at it, whatever companies that you're interested. You can see some of these companies have 100% in terms of business activity. Interest bearing debt is the highest, is actually UPS and Moody's. The rest of them are okay. And the one that actually surprised me in terms of Activision Blizzard when it comes to interest-bearing securities is about 18.8. Remember, the cutoff is about 30% for Zoya. Other companies look at about 33%. So there are 10 companies that this guy owns, okay? And now I'm going to show you his entire, 50 companies in the top 50 companies basically in his portfolio. And if you look at this, Apple, he has $123.66 billion of that company. So he owns quite a bit of this. So basically almost the 900 basically stocks of that company. And look at how much his average price is. His average price, let's round it up to $37. That's absolutely amazing. But he owned the company for a while. Same goes for Coca-Cola. I think Coca-Cola is probably one of the cheapest. So actually not bad. I thought it was actually a lot higher. But he's up about 57%, okay? 111% when it comes to American Express and so on. So you can see Activision Blizzard is there, Moody is there, TSM is there, HP, I think he bought it recently. What else is basically in there? Visa is there, Amazon is there. Who else? MasterCard is there, Mackenzie's we've already looked at. Snowflake, just very small, but he owns that as well. Okay, that's one of the high growth companies. T-Mobile's in there, and then a couple of other things. Actually, J&J is another company that I left out completely. That's great. Mondelez is actually also a good one that he owns in his portfolio, and he also owns the entire S&P 500, and UPS is also in there. So there you have it. Those are the companies that he owns in his portfolio. I just want to share that with you guys. The portfolio is doing all right today. I think it might cross over to actually to £64,000, okay? And I haven't added the money for this week. Inshallah, I will be adding that next couple of days. If you're new to the channel, I add £250 every single week, but because now I'm trying to maximize my ISA account, I will be adding a bit more in the next few months. So right now I need to add £7,000, and I've got January, February, March, and beginning of April. So 3 and a bit months left. Let's call it 3 months, okay, of adding that £7,000. Where is that going to come from? My salary is not money I saved. I'm not touching my what is it called, emergency fund. I'm going to use the money that I make from my salary, and I'm going to try to save and minimize my basic expenditure so I can buy more of these stocks and can maximize the advantage that I get with the ISA account. Okay, if you haven't signed up for this trading 212, I think they're still taking people on, so you can click the link and you'll get a free stock. I wouldn't get anything, I'll be honest with you. And I think I've got a few shares a little while back, and then they stopped it, I think. But you will definitely get a free share, I think, if you end up signing. Anyway, have a wonderful day. That's what I want to share with you guys. Assalamu Alaikum.